Nobody could watch more ticks in the S&Ps than I have over the last 40 years. So that should give me an edge, but it doesn't. There's no advantage to open interest.
Makes sense completely.
I think degrees are invaluable. I have been scalping for 43 years.
So what are you looking at when you're scalping?
I mean, there's no question that AI is going to be an extremely valuable tool in helping traders.
Thank you so much, Tom, for taking time out to talk to us. And you have been an incredible influence to me, especially. I know I'm here in India, but then I'm talking about a decade ago when there was nothing on the internet about probability-based options trading. And I still remember I was looking for something related to options way back then. And what showed up was an interview with where you were talking to Sheldon Natenberg, I think so. And that was long back. I'm not sure if you still remember that. And that was one of the old Tasty videos. And that's when I was wondering who this person is. And then, it's been a long time and I've been following Tasty content. So thank you so much for that. So with that, let's just jump in. For those of you who don't know Tom, Tom is a true trailblazer in modern finance. He began his journey as a floor trader on the CBOE floor, spending nearly 2 decades in the OEX pit. He's one of the original traders of S&P 100 index options. And from what I know, he is a pure contrarian at heart. Late in the 1990s, he founded Thinkorswim, an online options brokerage platform that reshaped retail trading. It was later acquired by TD Ameritrade for roughly $700 million. He didn't stop there. And, Tom went on to found Tastytrade, now Tastylive, a platform built with a simple belief that people are smart, they deserve to be challenged with real math, statistics, and probability, and not dumbed down content. Tasty was the first brokerage to offer options trading in retirement or IRA accounts in the US, or so I understand. And then this conviction led Tasty to become one of the world's largest digital financial networks, ultimately selling to IG Group for $1.1 billion in 2021. Awesome. His trading philosophy is grounded in statistics, that is, law of large numbers, encouraging traders to trade small and trade often. Even after decades of success, Tom doesn't show any sign of slowing down. Having recently stepped away from Tastylive, he is now building a new venture called Lost Dog. Tom, I must tell you this one. So I had many people in my circle who moved from India to the US for education or work. And whenever they talk about trading, I ask them to explore Tasty. And they've always come back to me asking me, how do you know about Tasty? We've been in the US and we don't know about it. And they've loved the platform. So something great that you built, I must say. Once again, thank you, Tom. And, it's a great honor to have you with us. Let's get started. I was wondering you would wear your signature beret, but looks like, after Thinkorswim and Tasty, the beret is out. What's the story?
The story is, after 25 years of wearing the beret, I decided to go natural as I begin my next venture into building, Lost Dog. So it's been a beautiful run. I've had a great time.
Yes.
I've loved every minute of it, but every once in a while you got to change things up.
Absolutely lovely. So let me get started with, I was just looking up a bit, and I understand you studied political science at SUNY Albany. So what was it at that point of time? What made you choose politics of all the things?
I'm a boomer. So I was born in an era where in America, it was there was a lot of political sensitivity in the early 70s, late 60s, early 70s. There was the Vietnam War. There was a lot of protests. Politics and political activity was pretty important to us in especially in my youth. And And to be fair, there really wasn't such a thing as a business degree back then. You could take economics, but there really wasn't such a thing called finance or business or entrepreneurship, back in the 70s. So I gravitated towards what I thought would be an interesting foundation, political science. When I got out of school, there weren't a lot of jobs, and I got an interview on Wall Street, and they offered me a job, so I took it. I've been here ever since.
Lovely. Yeah. So at that point of time, after you got into this first job, what was your sense of markets? You were new to markets, obviously, but what was your initial sense of stock markets? What did you know about it at that time when you joined Drexel?
I didn't know a hell of a lot because, as a kid growing up, very middle class, I didn't really, I never owned any stocks. I never had, I never was participating in the markets that much. But I gravitated towards it pretty quickly because I liked the action and I liked the risk aspect to it. I was always a risk taker, so I liked the risk part of it, which is why I ended up on the trading floors in Chicago, because once I found out that existed, I was in Chicago like basically the next day.
Lovely. So as you get to Chicago, was options as a product new to you, or was it new to America as well at that point of time? Was it an evolving product?
It was an evolving product. Options started kind of in the mid 70s as an offshoot from the Board of Trade, the commodity exchange, but they were just starting to take off. And the CBOE, which was kind of a new exchange at the time, was the biggest option exchange in America. And it was really busy. It was really active. Options were there was no real indexes, so they were all equity options. And options were just starting to take off. And, I had quickly gravitated towards options. I loved them from the first time I tried them. So I was basically hooked right from the start.
But then today we have a lot of it on the internet. We understand Greeks, how options work, volatility, whatever. But then did people understand all these dynamics even then with all, obviously there was limited information out there. But how did people understand this product? And was it very different from how we understand it today?
Oh, yeah, it was completely different. First of all, at the time when options were, when they first came out and became, even started to become popular, they were strictly used as a leveraged, speculative leveraged instrument. There wasn't much spreading. There wasn't much to options other than people would buy them as a kind of a cheap shot, an inexpensive leverage play. That's it. And it took, a couple of decades before, and it took a couple of decades and a lot of really innovative software starting in the early 2000s to change kind of the culture of option trading.
But then who would take the other side? Was it folks like you on the floor who would take the other side when many were buying?
When I first started, it was me. It was people like me. There was a few thousand people like me, and we would take the other side of every trade. There were no high frequency firms. By 2000, everything was starting to get done. The other side of every trade is, pretty much a prop firm or a high frequency firm. And today, it's 99% of every trade is interacted with a high frequency firm.
Okay. Yeah. So there was another question which I had. So floor traders like you, or it could be others, how did you make sense of the markets? Was it some kind of a directional play where, was it discretionary? Was it systematic? If I have to use these words, where would your thinking fit in? I mean, I'm talking about the days when you were on the floor.
Yeah. So I think the popular misconception is that floor traders have any idea what's going on. The reality of being a floor trader, a pit trader, was that our job was to take the other side of what anybody else wanted to do, because we would get a small amount of theoretical edge to do the other side. So it didn't matter what we thought, like whether we were bullish or bearish or whatever, it made no difference. We just every day came into work and took the other side of any kind of a customer order. That's all we cared about.
And was there some metric to how much risk you would take with you overnight, and all of that? Was there some math to it?
I mean, as an exchange member, there wasn't, but you had to learn quickly how to manage your risk. Otherwise, you wouldn't survive. I mean, in the world of floor trading, only about 5 or 6% of the people survived, and everybody else went out of business. So you had to learn. I did it for 20 years, so you had to learn pretty quickly how to survive.
All right, and what the people who wouldn't survive, they don't learn it. I'm assuming that
Yeah, they don't learn
they would
it.
just go out of business.
They trade too big. They have an opinion, whatever it is. They don't learn it.
Okay, and they would be out of business, obviously.
Out of business in a short period of time. Yep.
All right. Okay. So, so this is the other thing which comes to my mind. I'm shifting a bit about when I read about you. One of the things which I see is you always been about active investing, and I'm not sure if I can call you were against passive, but then I definitely, the sense that I get when I read about you is you were always for active. I just wanted to understand, double click on this a bit to understand what exactly do you mean by active, and why is passive not the best thing, if at all, if that's your idea.
Well, first of all, I don't have any. I'm not opposed to making passive investments by any stretch. I don't want to. I don't want to. I don't want people to be confused by what I preach and what I talk about and what I teach and all that kind of stuff. I'm never opposed to any kind of passive investment. The problem for me is, and the reason I think everybody should try active investing, is because passive investing is essentially dead money and it's brain dead activity. There's nothing to it. You buy something and you hold it until you're right. I mean, basically, you're right, you're wrong, whatever. There's nothing wrong with it, but to me, you don't learn anything from it. You don't gain anything from it. All you're hoping for is that over time, positive drift kicks in and you'll end up making some money over time. I'm totally fine with that, but to me, that's not strategic. That doesn't add real value to all your other skill sets. So the reason I'm such a proponent of active trading is because I want people to have takeaways from investing. I want you to learn how to be, I want you to learn how the numbers work. I want you to learn how to make decisions. I want you to learn how to speed up the way your brain reacts to risk. And I feel like there's so many really positive takeaways from active trading that there's nothing wrong with passive, but everybody should try active.
I get that completely, because the number of decisions that we end up making while being active, that has a massive impact on, of course, we make mistakes when we are active, but then that's how we learn. Instead, I mean, as you said, there's definitely an option to be completely passive and not do anything
Sure.
about it. So, makes sense. I see sense in being active, especially when it comes to learning how to make better decisions.
Yeah, I mean, one of the most important things in life, I don't care where you live, I don't care what you do, because, the way markets work, the way capitalism works, the way free markets work, is he or she who can make the quickest decision, understanding the probabilistic outcome of most decisions, is the most advantaged or the most successful long term. Life is about making quick decisions. Life is about making decisions. Those who never make decisions never learn how important the speed is, never learn how to process things quickly, and they kind of spend, much of their life stuck in the same rut.
How do you compare that with an idea of thinking through things and then acting? So doesn't it go against that idea?
That's an interesting, what drives me probably more crazy than anything else is when somebody says, I need to think about it. It is the, when somebody, whether it's one of my kids, whether it's somebody in business, whatever it is, whenever somebody says to me, I need some time to think about this, I just want to walk out of the room and say, you know what, we can't do business together. Because taking time to think about something just drives me out of my mind. You already know what you're going to do. Everybody already knows what they're going to do. Nobody that's ever a successful decision maker says, let me think about it.
Got it. Got it. Makes sense. Is that how you came up with the names for all the firms that you started, be it Thinkorswim or Tasty or Lost Dog? Is that how, intuitively you come up with these names?
I have a lot of fun coming up with fun names to build very serious pieces of technology. Thinkorswim was a groundbreaking piece of technology, but it was a silly name that I made up when I was walking, in my house one night. Tastytrade was a name I made up when we owned Thinkorswim. It's a name I made up that I had to negotiate when I left Thinkorswim to keep because I had bought it with the company credit card at the time and I wanted it. Lost Dog is a name that I've been sitting on for years because it's got a little personal meaning to me, but whatever. And so I don't actually care. Like, the name of companies doesn't mean much to me. It just needs to be something that's fun, that I feel I can market. I feel that, I've always felt that we do a really good job at organically marketing our products, our technology. And I think having a fun name has a lot to do with that.
Absolutely, you sure do, Tom. I had a thought when I was thinking when you decided to move out of Pitt to move out of trading to start a brokerage. Was there any other business idea that you had that you kind of compared with? Should I start Thinkorswim or a brokerage, or should I maybe start a hedge fund? I don't know. So was there some different ideas that you explored?
There were a bunch of ideas that we played with, but I never wanted. I had managed money a little bit during my trading career, and I did not like it. So there was never any intent to go out and manage money. There was an idea when we started Thinkorswim that we also wanted to build a derivatives platform that allowed for options on non-traditional things. So basically we wanted to create like a swap market, for an option swap market for anything that was non-traditional. We built a really cool exchange essentially for options on anything, but we couldn't get through the regulatory hurdles that, we couldn't get through the regulators because they thought that if you're creating an option, it's like a security, and because it's a security, it needs to be regulated, and therefore you can't do this because it's not exchange based. So we had to kind of drop that idea, and we just focused on building a listed option exchange. But we did have some ideas about, this is 25 years before there was a decentralized world. So yeah.
Yes, got it. And did you try that, or you just explored it with the regulator and you figured out it's not going to work?
No, we never tried it. We explored it with the regulator. Okay. Back then, like I said, there was no such thing as a decentralized product. There was no such thing as an over-the-counter product. So we explored it. We built some really cool technology, but we never launched it.
Got it. Do you think it's possible today?
Not in the U.S.
Okay.
I think there are some sites out there that do it in the digital asset world.
That's exactly what I meant.
Yeah, I mean, but it's hard because it's never been something that's been allowed in the U.S. And since I'm based in Chicago, there's not much I can do. I'm not moving to Bermuda or Cyprus, so it's hard. It's hard for me.
Got it. So after Thinkorswim, then we had Tasty. And when you started Tasty, was it the financial network first, or was it the brokerage first?
No,
or
was it the
both
financial
together?
network first.
Okay.
When we sold Thinkorswim, I loved Thinkorswim, but when we sold Thinkorswim, it was just it was time. We were ready to move on. And I wanted to build something that addressed what I felt was a financial media in the US. And I'm sure it's like this all over the world, but financial media in the US to me was very disingenuous. What that means is financial media to me didn't make any sense. As a viewer, I really don't care what somebody else's opinion is of the market or a certain stock. Like, I know that they don't know anything. Like, I know that if somebody comes on and says they love, they love NVIDIA here, or they love IBM or Microsoft, it doesn't mean anything. They don't know anything. They don't know if that stock, so I don't really care what their opinion is. I was hoping at some point financial media got somewhere where they were talking about strategies and numbers and probabilistic analysis and explaining, hey, here's why this option is priced here. Here's what the expected move is. Don't tell me some stock's you think it's going to go up $100 when the expected move is $6. So financial media was kind of driving me crazy. CNBC, Bloomberg, all that stuff. It just didn't make any sense to me. So I decided I wanted to build a network that was fun, that was different, that was digital. Remember, we built Tastytrade before there was such a thing as streaming networks. We were the first streaming network. It didn't exist. And so we built it.
I'm sure even the bandwidths were pretty low at that time. I don't know how people watched your show, but the bandwidths, we did not have the kind of broadband networks we have today.
You could watch it. It worked fine. Yeah, it worked. You're right. We didn't have the bandwidth we have today, but it did work. And what happened was, as soon as we launched it, we took a different approach. No news, no guests, no technical analysis, no fundamental analysis, just quantitative stuff, just math. And, basically hundreds of thousands, if not millions of people gravitated towards it because it was something that a lot of people wanted. It's what I thought, but I didn't know for sure. And I learned very quickly, hey, you know what? This is really interesting. We have something here. So for the next 5 years or 6 years, we did just the network. And then after the 6th year, we launched the brokerage firm.
Lovely. And when you did the network, how many hours in a day would you be live, or what was the format at that time?
With Tony, I did 3 hours in the morning and a half hour in the afternoon for 15 years. I did 3.5 hours a day minimum. I did podcasts, other things like that. I did 3.5 hours a day minimum, plus nights. Plus nights, we would do lots of special things, plus weekends. So, it was kind of crazy. Looking back at it, we broadcast we've had well over billions of views. It's insane.
It must have been a lot of work because it's not easy to be on a live show every day for 5 hours, and then you said you did something over the weekends as well. Must have been crazy.
It was, but you know what? I've been working my butt off for 40 years. I am a workaholic. I don't really care. So the craziest thing is when I did my last show like a couple of weeks ago, I was like, now what am I going to do? I didn't, I'm like, all right, I'm ready. I gotta, I don't like to have nothing on my plate.
Are you at a point where you're not going to office, you're not working? So how are you, how's your day today?
Oh, no. I've started a new company. I didn't even take a day off. I started a new company the next day. And we've been building it for a while, but I moved over the next day, took over as CEO. And now we have a really cool, AI / streaming network that we're launching a brand new streaming network on November 10th. That's 2 weeks from today. We're launching a new streaming network called One Lucky Dog, and it's launching on November 10th. And then we're also launching our software end of November, early December. And it's just a different business model. It's a different business altogether. I'm focusing in the US, I'm focusing on the wealth gap, and I'm focusing on worker inequity. I feel like nobody has really addressed worker fairness in using math and quantitative statistics. So basically what I'm doing is building these crazy option models to solve worker inequity. And it's going to be very interesting to see, what kind of takeaways, what kind of demand we have for it. I don't know yet.
Okay, and talking about worker inequity or compensation inequities. So, do you think the existing market forces won't solve it, and that's the reason why we need a solution?
The traditional way to solve worker inequity is either through social safety nets, through equal opportunity, regulations, through minimum wage, things like that. Those address the problem, but they don't solve the problem. The only way to solve the problem, and this is not US specific, this is global. The only way in every country to solve the problem of worker inequity is through education. And the only way you can empower workers is through education and letting them know kind of what they're worth so they have context around how to negotiate and and how to build the confidence to go after what they're worth.
And that's where Lost Dog comes in.
That's where it comes in. Exactly. That's the
All right.
technology
Okay.
we're building.
Lovely.
And that is the network that we're building. Now, this is not something that's going to be very easy. And it's probably going to be hard to, it's going to be hard for a lot of people to figure out, right, first what we're doing and how we're doing it. But I am going to go after CEOs that make way too much money, politicians that make way too much money, and corporations that make way too much money and don't treat their workers fairly and don't treat their employees fairly. And I'm going to empower those employees. And it's going to be one hell of a battle starting in 2 weeks.
I'm sure, but this is when you're going to put your political science degree to work.
But we'll see about that.
All right. Yeah. Okay. So coming back to financial content, how do you, you've been at the forefront of creating online financial content, even when nothing existed. How do you see it evolving today? Now that we have YouTube and there's a whole lot of content, almost every fintech or broking firm is trying to create content to as a means to engage with users. How do you see this space evolving?
Well, you're right. And everybody's trying to kind of copy what we built over the last, 15 years. The challenge is most of these firms are not that good at creating content, and their content is pretty much generic and it's not interesting. And they don't realize that the reason that Tasty was so successful is because we were different. We created content that was a little bit controversial, that was new, it was innovative. It is hard to do that. And I think they're going to find out, most firms are going to find out the hard way that it's not easy to do. I do think that content can be a differentiator if done right. I just think that it's a challenge for most of these old brokerage firms to do content right because they're just not that interesting. So that's the dilemma that they're going to have to face. I also think that there's a credibility piece. One of the reasons that Tasty worked was because I had a lot of credibility as a trader. I mean, it's all I've ever done. And I think that you can't put somebody up there that's never traded before and have them talk about trading, and people just don't care. They're like, okay, this is, what do I care what this person says? So I think they have a lot of challenges. I do think, though, that the true differentiator in a world where commissions are commoditized, in a world where technology has been commoditized, I think that you're talking about the one thing that you can't commoditize is truly creative content.
Makes sense completely. So, in fact, I've been watching tasty content for more than a decade now, and I don't think anyone has been able to do that job yet. So I'm sure there is something in the DNA of Tasty that you created that makes it so hard for others to even copy it, leave alone make it better. But even copying it
Yeah.
seems to be a difficult task.
Sure. I agree with you. That's, people always said to me, TD just launched a network, Ninja Trader just launched a network, IB just launched a network. And I'm like, okay, but they don't have me. That was my whole
I
thing.
agree.
Okay, great. Tell them to do whatever they want to do. I don't really care, but they can't copy us.
Yeah. So the other thought which I had on my mind while we are talking about content was today. Now, what is your perspective with all this content available on the internet, be it web or YouTube? What exactly is the value of university education now? If someone has to go to a university to learn finance versus learning stuff by themselves on the internet, and we have AI as well to help now. So how do you see this whole space evolving?
Well, I don't think that you can ever discount the value of university degree and undergraduate, graduate, PhD, and everything like that. I think degrees are invaluable, and for many reasons. First of all, there's a maturation process that you need to go through. Every 18-year-old, 19-year-old needs to learn how to grow up. They need to learn how to mature. They need to learn how to make friends. They need to learn how to network. They need to learn how to, play off one another. I can't stress how important university an education is at the university level. It's not it's of course anybody, a 10-year-old can use ChatGPT or Gemini or whatever you want to find out everything there is to know, on basically anything nowadays. But that does not make it actionable. That does not make it practical. And I feel like although a lot of the curriculums at different universities are outdated or they have had a hard time staying with the times, I can't stress enough how important the foundation is, for PhD students that we hire, for master's students that we hire, and for undergraduate, and for people that just have their bachelor's of science or their bachelor of arts. They are so much more valuable to us than somebody that just is self-taught. It's not even close. It's not, it drives me crazy when people think, you know what, because of all the information that's out there today, this university degree doesn't have the same kind of value. I would argue it probably has more value because on top of the university degree now, you can add on. I feel like what we do at Tasty is like a graduate program in itself. But you can add that on to your undergrad while you're doing it. And next thing you know, you have true differentiators to establish yourself as somebody that knows more than anybody else. And that's what I love about it.
So it means it's not just about knowing stuff, but it's also about engaging with others. And there's that human element which being at a university teaches. Is that what you're highlighting?
Yeah, of course.
Beyond the education, of course.
It's the maturation process. It's the networking process, 100%.
Got it. So talking about, so one of the things which I had on my mind was, I'm moving to trading right now in terms of specifically talking about markets, volatility. What exactly were some early misconceptions that you had, Tom, about the markets, and which you kind of overcame over time, which you learned? So what was it that you did not understand in the beginning that maybe over years or a few months, whenever that was, it kind of, okay, this is not how it works. So what was that?
Well, it takes a long time to teach yourself a couple things. Probably most importantly, because we all have, big egos, we all have ideas. It took me a really long time to realize that I really don't know what's going to happen next. Like, I thought I had some kind of an edge because all I do is sit around and watch markets every day for 4.5 decades. And I'm thinking to myself, nobody could watch more ticks in the S&Ps than I have over the last 40 years. So that should give me an edge, but it doesn't. And it took me a really long time to appreciate that I don't have any edge over anybody else in knowing what's going to happen next. I have a little bit of comfort knowing that I've kind of seen everything once or twice, but I don't have any edge.
If not edge, Tom, but over years, you would have developed an intuitive sense of the markets as to what could happen next. I'm not saying you would know it for sure, but you would have a better intuitive sense compared to others having watched the markets.
You would like to think so. I mean, I'm a contrarian, so I would like to think so. But markets can be, as you know, markets can be incredibly difficult, irrational, what we perceive to be irrational. They can be, there's a lot of people watching the exact same movie. It is very difficult, and there's only one movie playing at a time. It's difficult to be, to be different. It's difficult to. I'm always challenged. Let's put it this way: I'm always challenged. It's never easy.
Interesting. So I did think you would tell me that you figured out something and some holy grail kind of stuff. But yeah, it's difficult. I agree that But coming back to trading again, you've been a proponent of premium selling, but how do you deal with, or what's your thought on dealing with what we call as tail events, something which happened in August 24 and then April 25 again. So how do you, what's your thought on dealing with risk?
I mean, those are tough situations, like any time you're going to have outlier moves, whether it's once a year, twice a year, once every 3 years, whatever it is, you're going to have some pretty wild outlier moves. I have learned to deal with things by keeping my position size in check. I don't think there's a better way to do it. It's one of the biggest takeaways of the last, 15 years is learning to keep my position size in check.
And go with it. It will happen. You know that it'll happen a few times a year and just ease.
Yeah, I mean, I don't know that there's another way you can get around outlier risk other than trade size.
Got it. And if you look at a trading strategy, or are you a systematic trader in that sense? So that's my first question. Do you look at, or do you create trading strategies by looking at data, or do you recommend others do that? What's your thought on that in terms of designing trading strategies or thinking about trading in terms of systematic strategies?
I think that what I do is I apply different strategies to different levels of implied volatility. So it really depends for me. I mean, obviously we want to be capital efficient in everything that we do because I do play kind of a game, law of large numbers. But on top of that, I really base a lot of my strategy on different levels of implied volatility. If I think implied volatility is cheap, I will do things that I think are a little bit better for low implied volatility. And if I think volatility is expensive, I will take on more risk because I feel like there's more opportunity.
And would you also test it or simulate stuff? There are tools available. I'm sure Tasty also has those features where you can kind of backtest or simulate stuff.
I mean, Tasty has all those features for backtesting. I personally don't use them very often because I've pretty much seen every scenario. And I can also, my mind works in, I know it's going to sound weird, but I see things in different levels on different standard deviation levels. So when I look at stuff, I built our software so that essentially I can look at everything from with a two standard deviation perspective. And I can't go outside of that because outside of two standard deviations, then it's something that, it's pretty hard to quantify. So my whole world is inside of two standard deviations, and I'm able to visualize that for really any trade I make.
So that's exactly what I meant, Tom. And I said that, have you developed an intuitive sense? And I guess you have. So in your mind, you know what happens within two deviations.
Yeah, it's pretty easy actually to do in the US markets because most of the brokerage firms require enough capital to carry a two standard deviation move. So you can look at your buying power reduction as one way of getting to that number.
I get that. Makes sense. And are there, talking about in the world of options, are there any other than implied volatility? Is there anything else which you look at as a leading indicator of what could happen for a given spread or a structure? Do you look at something else beyond implied volatility?
I mean, I occasionally will look at, I do look at price because not that I'm only making a subjective opinion on price, but I do look for situations where I think the price is at an extreme. I also will look for extreme situations in skew. I don't search by skew, but I do look at the option pricing skew to see, how much the market is pricing in, upside or downside pricing skew.
Got it. And here in India, one of the things which a lot of traders look at is open interest across different strikes. That's something which I don't see much in the US, especially. Any idea as to whether it has any informational advantage over other things?
We trade mostly liquid underlyings. There's no advantage to open interest, especially if you're trading indexes or liquid underlyings. I think the only time we'll ever look at open interest is if we're trading something that's very illiquid, just because we'd like to know, is anybody else trading it? But I stick to mostly 99% of my trades are very liquid underlyings, so open interest is not a factor.
Got it. Thanks. So I'll move on to the next one, which is, Tom, I'm a trend follower, Tom, and you've been, the little that I've read about you or heard in your interviews, I've not heard much about trend following from you. So what's your honest take on trend following? You can speak your mind. I won't get offended. It's okay.
Well, so I'm a contrarian, so I am not a trend follower. If anything, I fade trends. So I have made my living fading trends. That's who I am. I don't believe that there's such a thing as a trend. I mean, obviously, like right now we're in a crazy bull market and of course there are stocks that go hyperbolic or that get crushed, things like that. But I'm not somebody that believes that there's anything more to it than it's just a random case of multiple days in a row.
Then how do you make sense of all these CTAs who run managed futures funds and all of that? There's a whole industry to it, billions of dollars to it. So how do you make sense of it?
I don't try to. I don't know exactly what those guys do. I don't know how successful they are. I haven't seen results of a lot of commodity trading advisors who have been very successful. I know that there's a handful that have made money, but I think that's just actually a statistical, exactly what's supposed to happen statistically. My argument would be that in black and white instruments like futures, it is very difficult to manage a directional fund based on trends. That's just my two cents.
Got it. Got it. So that brings me to the question: what does diversification mean for you? Because if you are going to be a contrarian, and if you are, especially in the context of, let's say, if you're in the business of premium selling, how do you diversify there in that context, if someone has to?
Well, the challenge there is you diversify through non-correlated underlyings and through strategy. I'm really good at using all the products available to me. So, for example, like I'll trade something that is not correlated to the market, like gold or silver or, bonds. They're not correlated to stocks. And so I think that that's a big part of, how do we stay diversified?
Got it. So, but the diversification is not in terms of strategy, but more in terms of products and assets. Is what you.
That's correct.
Got it. Got it. So I remember there's another thing. I'm not sure. A few years back, it could be 5 or 6 years back, or more, maybe a decade back. Tom and you did a series on scalping with Tony. Okay. And I remember it was like some 5 or 6 videos on scalping, and it was something very new and exciting to me at that point of time. So I still remember it. That's
Okay, sure.
So one of the questions, I'm not sure if you would still remember. So one of the questions which I had was scalping something very intuitive to you, or was there some method to what you were doing? I'm just curious. A lot of people ask me that question. So I thought I should ask you.
Well, I have been scalping for 43 years. So when you say, is this something that's intuitive to me or something that I enjoy doing? The answer is yes. Because even today, I've been scalping S&P futures this morning. I've been, scalping some stocks in addition to my position trading. So, I've already made probably 30 scalps this morning. So the answer to your question is yes, I've been doing it my entire life, and I'll continue to do it till the day I die, I'm sure. So yeah, it's important to me. It's an engagement tool. It's fun. It keeps my mind sharp. It keeps me on top of everything that's going on in the markets. It's literally part of my being is intuitively scalping the markets. Sometimes I think I'm good at it, but again, I've been doing it a long time. But you know what? I do it more because I love it than anything else.
Okay, but you also say you're not a chartist. So what are you looking at when you're scalping?
Oh, I've never looked at a chart in 4 decades. I'm not looking at anything on charts. I'm just looking at price. I know every single price. I don't, all I do is watch markets. I don't need to look at a chart to tell you, where we are or where we've been or anything like that. I promise you could not stump me on where the market is or anything like that.
Got it. It's interesting. So that's something which I had on my mind. I'm so glad I've been able to ask you this question. There's another question which comes to my mind talking about strategies. So given that you've been in the markets for 4 decades, are there things that you saw, are there anomalies which you saw existed at one point of time, but today, it makes no sense to trade them? And what are they, if you remember any of those?
There's some indexes that, there's always going to be some indexes and some stocks that used to be super liquid and that just, they're not there anymore. Different indexes that have dried up, different products that have, there's always some rotation. So I think, when I first started trading, the most actively traded equity was IBM. Now IBM's not even in the top 100. So it just depends. When I started trading the S&P 100, the OEX was the most actively traded index. Today, it doesn't even trade anymore. So, it really just depends. A lot of things change. I wouldn't read too much into that because there's tons of new stuff as well.
So, as a trader, if someone is starting right now, how do they think about it? So, how do they kind of factor in um, the the changing possibility of products, and so what kind of an edge should one develop if I have to, if I have to build a career in this area, if I have to become a better trader?
Well, I think the key to becoming a better trader is to trade. I know that sounds so basic, but I think
Yes.
it's the kind of business where you have to get involved in order to really understand. There's a lot of know-how. There's a lot of experience that you get from just, pushing buttons and doing certain things. And it's hard. And I think you just need to experience it to see if it's something that you like, that gets you excited.
And is there, I mean, I know it's related, but then is is that how you think one can develop an intuitive sense of what's going to work and what doesn't? Or, are there things that you would see in a winning strategy or something? If you look at a strategy, you say, okay, how do you develop that sense that, hey, this approach to markets is not going to work? How do you?
I think it's really important that you figure that out. I think different people have different risk tolerances. Like, for example, some people are very comfortable with undefined risk. Other people are very uncomfortable with undefined risk. And I think it's impossible to bucket everything, to blanket everything and generalize. I think you have to let people experiment for themselves. Some people like equities. Some people only like indexes. Some people only like defined risk. Some people only like credit spreads. Other people only like naked strangles, or naked options. Some people only like to be long options. Some people only like to be short options. Some people only like to sell naked puts. It really depends. I'm not gonna guess on this one. I just think you need to play around and experiment.
All right. I think it makes sense. You find out each one of us would figure out our own sweet spot over time.
I think that is the case, truly.
Okay. So other thought, which you said you should punch in orders and all that, that goes. So there's a lot of talk about automation and using APIs to punch orders, all of that. Even here in India, brokers are giving out APIs which can be used to automate trades. What's your thought on that? Is that the future? Is that how a lot of retail? I'm talking more about retail here. Is that how retail is going to trade?
I doubt it. I don't believe so. I believe that it's very difficult to code and to program a trading bot to think for you. I'm a brains over bots guy. I don't see myself. I think that there's certain pieces of technology that can help you in lots of different ways. I mean, there's no question that AI is going to be an extremely valuable tool in helping traders. It's going to accelerate the learning process. It's going to help you look at your multiple layers of outlier risk. It's going to help explain to you things like, position risk and trade risk, and it's going to help you to quantify things that normally you wouldn't even thought about. So I think AI is going to be a very positive and valuable tool for traders. I think trading bots, on the other hand, are going to be pretty mixed. I don't see I don't see them as being the future. Let's put it that way.
How about third-party tools which would help you? Let's say you don't no code solutions, as they call it. So you kind of configure something and it'll execute trades for you rather than you doing it for yourself.
I find it incredibly hard. So the way I'll say it is that most of the high frequency and prop firms that automate trading find it almost impossible to automate opening trades like that. Almost impossible. And their technology is, and their data feeds are faster, their technology's faster, and their technology's much, much better than retail technology as far as execution goes. If it doesn't work for them, I don't know how it could possibly work for a retail investor.
So you mean a lot of trading will for the foreseeable future is going to be manual? Is that, I mean, is there a number to it? I'm sure you would know, as in Tasty, the number of users or subscribers, or customers who use the API to kind of punch in their orders. Do you see a trend there?
I mean, it's a growing number of users, but it's a very small percentage of the order flow. So when you're talking about percentage of order flow, it's less than 2% of all the order flow. There's definitely a growing number of users who are experimenting, but again, the order flow percentage is really small.
Got it. I'm quite bullish the way I see it here, but it depends. As I said, I think the story is similar in India as well, where the number of, as a percentage of the order flow, it'll be very small. But then if you look at it among traders, a lot of them are excited about using technology.
I understand the excitement piece to it. I get it. But I just think that most people don't realize what you're up against. So if you are doing something on your own, you can make a lot of subjective decisions, which is good. If you're trying to run a bot, your bot is going up against the best bots in the world. And now you're going to say, well, so are you if you're putting in your own orders. And the answer is, yeah, of course. But it's a little bit different when you're trying to run your bot to go up against, for example, Citadel's bot or Jane Street's bot or everybody else. Their bots are better than your bot. That's my point. Your bot is a leased, couple of dollars a month, couple $100 a month. You're leasing a bot from some third-party developer who cannot compete with $100 million platform that runs in 6 milliseconds or $1 billion platform that runs in 6 milliseconds with better markets and better theoreticals than everything you have. And so my issue with it is you are totally disadvantaged right out of the chute.
Got it. So you spoke about Jane Street, and I'm not sure if you followed the story in India, where the regulator in India went against Jane Street because they claimed that Jane Street was manipulating the markets. I'm not sure if you heard about that.
Oh yeah, I followed it.
Okay, so what do you have to say about that? Just curious, what's your thought? Was it market manipulation, or was it a bad index in terms of how the index was structured? What's your thought?
So, again, we're going to get back to, the Indian regulators, because I have spent a lot of time with Indian regulators trying to accomplish certain things I was not able to accomplish. The regulatory environment in India is a little bit antiquated. It's very protective. I'll leave it there. And it hasn't evolved to where it needs to be to build any very efficient and growing, marketplace. The Indian markets are very limited to a few products and to a certain type of product. The technology, the front end technology has gotten significantly better in India, but the exchange technology and the regulatory environment has not kept up with the front end technology. So in India right now, you can get a really decent piece of front end technology as a consumer, but the exchange technology and what you're allowed to do and the way the capital requirements work on exchange level, especially for derivatives, has not kept pace with the front end technology. This is a very kind of almost a normal situation as there's growth in the system. I'm sure Jane Street is not, they're not altar boys, okay? It's not, they're a very competitive firm. My experience with them is their technology is really good. And my guess is that they took advantage of really bad exchange technology and really bad exchange routing rules and things like that. And my guess is that they didn't do anything that would be even remotely considered illegal in the US, but in India, they disrupted the marketplace. And it was like, as we say, shooting fish in a barrel type thing. Yeah, and so I guess the bottom line for me is that I feel like this is kind of a blessing. What happened is kind of a blessing for the Indian markets, derivatives markets, because now they are going to accelerate regulatory changes and exchange changes to focus on real high frequency market making, which is necessary in India. The high frequency firms in India, are not as good as Jane Street yet. And now that those firms are getting in there, there's going to be the marketplace is going to completely change. And you're going to get better markets, fairer markets, more products, more capital efficiency, and better exchange technology. So the bottom line of this whole Jane Street thing is that it's going to benefit the entire listed marketplace in India in a big way. That's how change happens.
I really hope it does, Tom. That reminds me about another thing. I'm not sure if you followed this one. Now, in India, post 2020, we had, like it happened in the US, we had a boom in terms of trading as such, not just in options as a segment, but across. So the number of accounts which got opened, all of that shot up. That is one side. The other side of it was we had a whole lot of traders who came into the market post COVID, and exchanges came up with different products, and there were multiple indexes on which options were launched, and each product had an expiry on a different day. So 5 days a week, we would have some zero-DTE expiry. So this is not exactly the zero-DTE what you have, but then this is a different product expiring each day of the week. And obviously, there were a lot of traders who took to it, and somehow, the volumes of those options were too high. So I was saying we had this, and then the regulator came in because there was a lot of speculation, a lot of volume which was going into these activities, and there were reports of people losing money, which happens obviously. So they kind of shut it down. They kind of sunset 3 or 4 indexes and decided that there's only going to be 2 indexes on which we would have weekly options. The rest of them would not have weekly expiration. We'll have only monthly expiration on the rest of the indexes. Now that's how they solved it. But then I'm not sure, if that's the best way to deal with it. Do you have any thoughts on that?
Well, it's not the best way to deal with it because, the last thing you want is the regulators, quote, trying to protect you. Mm-hmm. That's, they make things worse, not better. I'm all for, as many products as possible. I just think the challenge, there's my experience in India, because I can't trade the markets there, so I don't have hands-on experience with the markets. But from what I have, given a lecture at the Mumbai Stock Exchange, and also, I've met with the head of the exchange and a couple of the regulators there before, and my gut instinct says that the exchange is trying to play, what they're saying is they're trying to protect the individuals, but the reality is they're making it worse, not better. And I just don't think you can't, if you want to protect everybody and not let them trade, if that's what you think protection is, then that's fine. But don't throw out like, partial products. It doesn't make any sense to me.
I wish there are more voices like you, Tom. Okay, so that how did US take to zero DTE? Talking about zero, because we were talking about zero DTE. There were questions about market stability, and there could be some kind of systematic or systemic risk that could come in because of zero DTE. And how did that play out in the US?
Well, I mean, take a look at it. It hasn't had any impact at all. The market's at record highs, and there has been no systemic risk that I can tell from zero DTEs. So to this point, it has not been a problem.
All right. Well, but were there voices which said that this is not a good thing? Zero DTE doesn't add any value to the market or the ecosystem.
Well, that's I understand that, but that assumes that you believe that the only value to the ecosystem is that is what people can take out of that one specific trade. My argument to that would be that the value to the ecosystem is that it's brought a record amount of volume to the listed exchanges in the U.S., which is why we're the center of liquidity for the entire world. So I would argue that the exact opposite, in that zero DTE and other trading instruments like that have kept the U.S. as the true largest pool of liquidity anywhere in the world 10 times over, which helps to fuel all the innovation and things like that. So I think it's very short-sighted to think that, okay, the product doesn't bring any, doesn't serve any purpose. I completely disagree.
Got it. Okay, so that brings us to the end, Tom, and I have a few questions. Now, you were telling me in your initial days you would shoot 5 days a week or all of that, and you continue to do that. Is there a specific routine that you follow to keep you going? How do you do that? That's the question.
I don't have any hobbies.
But is there a schedule that you follow in terms of to make sure that you are right there, just to keep you mentally going every day? And that's not easy, I'm sure.
It's I think that's personal in the sense that it has never been a problem for me to motivate myself and to get myself, to want to work. So no, that's not an issue for me. I enjoy working. It keeps me alive. It keeps me, young. It keeps me vibrant. It's important to me.
I wish we all could have something like that. So I wish more of that for you. So what comes to my mind is, I'm really happy that you took time out to talk to us, and I really wish you continue with the same energy as you go on to build Lost Dog. We would love to host you here in India whenever you are here next. I know I'm not sure if you like this market, but then we are happy to have you here. And I would love to connect with you if I'm in Chicago.
I would love to take you out for an amazing dinner in Chicago. And if I get to India, I will for sure let you know if I get back. And I assume I will at some point. I just don't have it in my immediate plans.
Lovely. Thank you so much, Tom. Thank you for taking time out. And, I hope to have you back again sometime on the show.
Thanks, Andy.
Thank you.
Appreciate it.
Thank you. Thank you, Tom.